One thing to consider is this year the state and local tax cap, so what we call the SALT limit, that has increased for 2025 from $10,000 to $40,000. So taxpayers should consider paying their state estimated tax payment before year end because they're much more likely to actually get the deduction with that increased cap.
Hello, and welcome to another episode of It Depends, a podcast series brought to you by Hantzmon Wiebel. You know that if you've ever talked to an accountant, they've told you, well, it depends. This podcast series is for business owners, leaders, operators, accountants, or someone just wanting to learn more about the accounting industry. I'm your host, Clarissa Hoffman. Today we are joined by Jim Hutcherson, a partner in our tax department. Thanks for joining us, Jim.
Happy to be here. Thanks for having me.
Can you tell us a little bit about yourself?
Sure. So my name is Jim Hutcherson. I'm a CPA here at Hantzmon Wiebel. I've been here for almost 21 years now. I work on the tax side of the practice, work a lot with small businesses and individuals, many times the owners of the businesses, and again, focus mostly on tax work.
So today we are talking about year-end tax planning, specifically in relation to calendar year 2025. What should taxpayers consider in regards to their fourth quarter estimate that's due in January?
Sure. So one thing to consider is this year the state and local tax cap, so what we call the SALT limit, that has increased for 2025 from $10,000 to $40,000. So taxpayers should consider paying their state estimated tax payment before year end because they're much more likely to actually get the deduction with that increased cap. Another thing to consider is if your income has gone up for 2025 and you have not been paying in safe estimates. So safe estimates are 110% of your prior year 2024 tax. If you haven't paid in safe estimates, you should consider increasing your fourth quarter estimated tax payment. Another thing you can do is if you have W-2 income or even a retirement distribution coming on a 1099-R, you could consider increasing your withholdings. And an advantage to increasing your withholdings as opposed to just increasing your estimated tax payment is withholdings, they're considered paid in evenly throughout the year, even if you do the withholding at year end. Whereas with your estimated tax payments, they're considered paid in on the date they're actually paid in. So if you're in a situation where you're trying to cut down on your estimated tax penalties, increasing your withholdings might be a better route to go rather than increasing your fourth quarter estimated tax payment.
Should taxpayers consider retirement plan contributions as we approach the fourth quarter?
Definitely. So retirement plan deferrals are something you should think about. So if you're part of an employer retirement plan, so a 401k or a 403b plan, you want to think about your deferrals and whether you want to maximize them for the year. So I believe the limit for 2025 is $23,500. And then if you're age 50 or older, there's an additional $7,500 that you can do. And then actually for 2025, I believe if you're age 60 to 63, there's an additional $3,750 that you can do for 2025. And so another thing to think about is IRA contributions. So if you're not part of an employer plan, there's still a way to put away money for retirement, and that's through an IRA contribution. So there's a traditional IRA, which you fund that with pre-tax money, and then it grows tax deferred, and then when you pull it out later, that's when it's taxed. Now there are income limitations to be able to deduct a traditional IRA contribution. If you're not covered by an employer retirement plan, then there's no income limitation. You can make the contribution and you can deduct the contribution. If either you or your spouse are covered by an employer plan, then income limitations come into play. And you can still make the contribution, but it just may not be deductible. So it may create basis in your IRA. The other type of IRA is a Roth IRA. And with a Roth IRA, you fund that with after-tax dollars, so you don't get a deduction up front. But then it grows tax-free forever. So when you pull it out later, it's not taxed. It's never taxed again. Now, with Roth IRAs, the thing to be careful about is there are income limitations to be able to make a Roth contribution, and the income limitations actually prevent you from making the contribution altogether. And it doesn't matter if you are covered by a retirement plan or not. Those income limitations apply no matter what. So another thing to think about is a Roth conversion. So before we were talking about if your income goes up and we were talking about increasing your withholdings or increasing your fourth quarter estimated tax payment, Well, if you're in the opposite situation, if your income is abnormally low for 2025, you could consider doing a Roth conversion. And what you're doing there is you're taking a pre-tax IRA and converting it to a Roth and paying the tax on it. And so then from that point forward, it'll grow without tax and you'll never be taxed again. And a strategy that a lot of people take is if they have a really abnormally low income year, they'll do a Roth conversion with the goal of filling up those low tax brackets. Because we do have a graduated tax system where, the rates go up as your income goes up. And so what a lot of people do is they'll try to fill those low tax brackets up through, say, the 24% tax bracket, because there's an 8% jump from the 24% bracket up to the 32% bracket. And I think for single filers, that 8% jump from 24% to 32% is at about $200,000 of taxable income. For married filing joint, it's about $400,000 of taxable income, where it jumps from 24% to 32%. And so that can be, again, a strategy. If you have an abnormally low income year, you could consider doing a Roth conversion to get that taxed at a really low rate in those low brackets.
Are charitable contributions a strategy that taxpayers should consider?
Definitely. So again, we talked about the state and local tax limit increasing from $10,000 to $40,000. And so what that has to do with charitable contributions is, okay, if we back up and think about the last several years, from about 2018 through 2024, we had the combination of the $10,000 state and local tax limit combined with a really high standard deduction of about $25,000 to $30,000. And so if you were in a situation where you didn't have home mortgage interest, then you were stuck with your $10,000 state and local tax deduction. And then you had to make some other kind of deduction happen, usually charitable contributions, in a range of $15,000 to $20,000 to get over that $25,000 to $30,000 standard deduction. So now, with the state and local tax limit increased to $40,000, there's going to be a lot more taxpayers that are already close to that standard deduction limit. So what that means is if you make a charitable contribution, which is also an itemized deduction, you're going to be getting over that standard deduction hurdle a lot more quickly. Exactly. So you do definitely want to consider making charitable contributions in 2025 before the year end, because you're much more likely to get the deduction than previously. Another thing to consider is, so if you're at retirement age and you're already over what's called the required minimum distribution age, so you're having to take money out of your retirement account, out of your IRA, what you can do is you can have that paid directly to a charity, and that's called a qualified charitable distribution. And if you do that, that income, it never goes into your taxable income. So you're basically getting the 100% deduction benefit. Another good reason to do that is most of the limits and phase outs in your tax return are driven by your adjusted gross income. So if you can make a charitable contribution without it ever going into your AGI, then you're also going to cut down on those other limits that are happening in your tax return. And so you're going to save taxes in other areas, not just from the charitable contribution.
Are there any other considerations for IRAs that taxpayers should make?
Definitely. So we just mentioned required minimum distributions. And so currently the law is once you turn age 73, then you're required to start taking distributions from your retirement account. And so in the year that you turn 73, you have to make sure you start pulling out those RMDs. And there is a pretty steep penalty if you miss that. So you just want to pay attention to that if you turn age 73 in 2025. There is the option to take your first RMD by April 1st of the following year. So you could do that in 2026 by April 1st. However, then you do have to take your second RMD in 2026 as well. So then you're doubling up RMDs in 1 year. And usually, every taxpayer situation is different, but many times that will cause someone to jump into a higher tax bracket, and so you end up paying more tax than you would have if you would have just taken them in the 2 separate years. So that's something to keep in mind. Another thing to think about is if you inherited an IRA in 2025. So if you had a family member or friend pass away, unfortunately, in 2025, and you inherit an IRA or other type of retirement account, you just want to check the specific rules that apply to you, because even if you haven't turned age 73 yet, you may be required to pull money out of that retirement account. And the rules have changed a lot with that over the last several years, and it can be a little bit complicated. So just make sure you look at your specific situation if you inherit an IRA in 2025.
Any last pieces of advice as we approach the end of the year?
So a couple of other things to consider, this concept called loss harvesting. And so if you have capital gains in 2025, or if you know you're going to have some sort of event that's generating capital gain between now and year end, whether you're selling a piece of real estate or if you sold some stock and you had some capital gains, you want to look and see if there are potential capital losses that you can harvest. So if there's another investment you can sell to generate some capital loss to offset those capital gains. Because capital losses, they can offset capital gains dollar for dollar. You can offset 100% of your capital gains, but you can only offset $3,000 of ordinary income with capital losses, and then the rest carry forward. So you want to see if there's any capital losses you can trigger if you have capital gains coming in 2025. But also you want to look at it from an economic perspective. And so you don't just want to sell an investment that's in a loss position just to generate the loss. You definitely want to look at it from an economic perspective. If you have an investment advisor, talk to your investment advisor, because you may have an investment that's currently in a loss position, but it may be a good investment that you want to keep for the longer term. So there's a saying we say called, don't let the tax tail wag the dog. So that's definitely a situation where that saying applies. So another thing you can think about is family gifting. And so any individual can gift up to $19,000 to a family member or friend. It doesn't have to be a relative. And there's no estate or gift tax implications with that gift. And so if you're a married couple, you can jointly give $38,000 to any individual without any gift or estate tax implications. And so right now, our estate tax system, there is a $14 million lifetime exemption. So you have to have a fair amount of wealth for the estate tax to apply to you. But if you stay under that $19,000 limit for gifting, then you don't use any of that lifetime of your 14 million lifetime exclusion. And so that's just another thing to keep in mind as you move forward towards the end of the year.
And gifts that would stay under that $19,000 don't require a gift tax return. So it eases the administrative burden of gifting a little bit as well.
Exactly. And another question that we get lots of times is the person receiving the gift, is that taxable income to them? Do they have any filing requirement? And the answer is no, it's not taxable income, and there's nothing they have to report either. So staying under that $19,000 limit, it's just a really easy way to gift money to people without any sort of gift estate or income tax implications.
So great advice on the QCD. Just an item of note, it's important for taxpayers to tell us as tax preparers that you made that QCD, because that is not included on the documentation that we receive from the brokers.
That's a really good point. That's the only way we would know, is if the client told us they made the QCD. Thanks for adding that.
Thank you so much, Jim, for sharing this information. I know it will be very helpful for taxpayers as we approach the end of the year.
You're welcome. I was happy to do it. And do you by any chance know what the next topic will be?
Well, it depends.